Now let's look at bonds. Now a bond is a borrowing agreement in which the borrower or the issuer of the bond promises to pay the investor a certain sum of money after a certain period of time, and during that period he's going to be paying interest at a certain interest rate. So guys, let's put a bond out here. So let's say we at Mild CPA Review, we need money for expansion, so we are issuing out bonds. So we say on the bond that we promise to pay the investor of these bonds $100,000. Let's say this is a $100,000 bond after a period of 5 long years. And during those 5 years, we're going to be paying interest at, let's say, 7%. Then we type out this promise on a piece of paper, sign it, seal it. And we give this bond, this piece of paper, and take in $100,000 for each piece of paper, each bond. So guys, looking at this bond, $100,000, you could say this is the face value of the bond. 5 years, this is the period of time or the term of the bond. When you're looking at 7%, that's the stated interest rate. You could call it stated rate, contract rate. You could also call it coupon rate. So now we've issued out these bonds, collected $100,000 each bond. So guys, this is a liability for us. So when we issued out these bonds, so we got in cash and we had bonds payable. And because it's, let's say, $100,000, we got in cash $100,000 for each bond that we issued. And bonds payable was $100,000. So that was when we issued the bonds. Now, every year or the next 5 years, we're going to be paying interest on these bonds at 7%. So we're going to be paying interest. So the journal entry for that is going to be, it's going to be an interest expense for us. And we're going to be paying out cash. So let's say $7,000 each year over the next 5 years. So this is for 5 years. Now, after 5 years, the investor, he's going to come back to us with this piece of paper, with this bond, and he's going to take back the $100,000 that he gave to us. So then we're going to clear off, we're going to retire this bond. So then it's going to be bonds payable. The liability is gone now and cash goes out, $100,000. So guys, if you look at our balance sheet, we're going to have bonds payable out here, and that's going to be for $100,000. Every year we're going to be paying interest here, so $7,000 of interest every year for the next 5 years. After 5 years, the investor is going to come back, take back these $100,000 from us. So guys, that is the concept of bonds. So here Mild CPA Review is the borrower or the issuer of the bonds. Now, when we planned to issue bonds, we had a detailed discussion with our investment bankers, and they told us that we could issue various kinds of bonds. So when we were discussing, we talked about the various classifications of bonds or the various kinds of bonds that we could issue. They said that we could do a term bond. So this is a term bond because the entire $100,000 matures as of a single date after 5 years. So this one was a term bond. Now, what we could also have done, we didn't do it, but we could have done is issue a serial bond. Now, in a serial bond, instead of the entire $100,000 maturing after 5 years, we could have, let's say, $20,000 mature each year. So that would have been a serial bond which matures in a series of installment. Term bond, single maturity date. So this would have been classification on the basis of maturity. Then we could also have classification on the basis of security. So the bond that we issued, this one was an unsecured bond. This one is called a debenture bond. So if we default, you can't do anything. So there's no asset against which this bond is secured. So we could have issued a secured bond. So let's say if the bond was secured against some assets that we had, which served as collateral, this would have been a secured bond, or even a mortgage bond if it was secured by real property. But what we did was we issued out unsecured bond because people, they love us, they trust us, versus unsecured bonds, which are also called, unsecured bonds are also called debenture bonds. Now, what the bankers said was we could also make this bond a convertible bond. So that sounds like a convertible car, right? So you have a car which is roof, and suddenly you get the roof out and you get some air. That's a convertible car. Now this one could have been a convertible bond. Now what that means is, let's say when we issued out this bond, this was a debt, a bond payable on a balance sheet. We could have given an option to the investors that if they wanted, now again, if they wanted, option means right but not obligation. So if they want, they can come back to us with this piece of paper, with the bond, and take back our equity stock. So the debt would convert to equity. That would have been a convertible bond. This bond could have been converted at the investor's option to equity. Or what we could have done was we could have given a warrant free with this bond. So guys, you often love when you get something free when you buy something, right? So let's say you're going out to buy a laptop and you get a bunch of DVDs free. Sometimes those DVDs, they excite you more than the laptop. So that is what we could have done. We could have issued free warrants along with this bond. So the investor could have kept this bond with him. He could have come back to us with a warrant and taken a stock. He could have exercised that warrant. That would have been an option to buy equity. So he would have to pay some cash when he gave the warrant and take back equity stock. So it could have been convertible bond. So convertible bond means this bond would have been converted to stock. A bond with detachable warrants mean along with this bond we are giving free warrants. They can come back with the warrants, take back stock. They need to pay some cash because that's an option that they can exercise. Then what we discussed was, there were a lot of investors who were ready to buy our bonds. A lot of people, they simply love the work that we're doing. So they're ready to invest in us. Now, because we had so much of demand for these bonds, we said, why not make it a little more advantageous for us? We could have made these bonds callable bond. Now, callable bond, what does that mean? That means we have an option to call back the bonds whenever we want. So guys, we said this bond, this is for 5 years. But let us say after the second year, we feel that we've got a lot of cash. What we can do is we can tell the investors, come back with your bond, take your cash. So that's our option, our benefit. Conversion option was the investor's benefit. Callability, that's our benefit, the issuer's benefit. Or what we could also have done smartly was, let's say the interest on this bond, the stated interest rate is 7%. So we're paying interest at 7% each year. If the market interest rate dropped, if the 7% interest rate dropped, let's say we issued it at 7%, but next year the interest rate goes down to 5%. Then what we can do is we can take in new debt at 5% and call back these bonds, repay the 7% debt. So that was a benefit to us, not to the investors. That was the issuer's benefit, the callable bond. Now, what we could also have done. So guys, I'm talking about the various things, various classifications of bonds, the various kinds of bonds that we could have issued. We could also have issued a zero coupon bond. Zero coupon, that sounds lovely, right? That means this interest rate, 7%, would have been 0%. Would anybody have taken this bond? Think about it. I'm asking the investor, give me $100,000 now, come back after 5 years, take back your $100,000. During this 5 years, I'll pay you nothing. Guys, we just learned the time value of money. Money should grow. So if it's a zero coupon bond, the money doesn't seem to grow. That is why whenever you issue a zero coupon bond, though the interest rate is 0%, you give a deep discount. So what I tell the investors is, okay, I'm not going to pay you interest over the next 5 years. But what you do is just come with $70,000 now. So instead of giving me $100,000, give me only $70,000 now. And after 5 years, I'm going to give you back $100,000. Think about it. I'm paying no interest over 5 years, but after 5 years, I'm giving back much more. So in that case, the zero coupon bond would have been a deep discount bond. It's also called a non-interest bearing bond. So guys, let's get to the book, look at all this content, and we'll come back with a lot more on bonds. On page 7, we're looking at types of bonds. So a bond is a borrowing agreement in which highlight borrower or issuer. Now he promises to pay a certain sum of highlight money, face or par value to the purchaser after highlight certain period of time, that's the term, and at highlight certain interest rate, that's the stated or contract interest rate. Now in the second bullet, we're looking at the types or classification of bonds based on, put a box around maturity, highlight term bond, underline single maturity date, highlight serial bond, and underline matures in a series of installments. Next one, classification based on, put a box around security, highlight secured bonds, so that's secured by collateral, highlight unsecured bonds, and underline debenture bonds. Next one, highlight convertible bond and underline option to convert to common stock, highlight callable bond and underline issuer has right to redeem or call before maturity date, and highlight zero coupon bonds and underline deep discount or non-interest bearing bonds. Now guys, let us say we've gotten these bonds printed. We are promising to pay interest at 7%. That's a stated rate, coupon rate. Now after we get these bonds printed, we realize that the market rate of interest for our credit ratings has gone up. It's 8% now. Do you think anybody would buy a 7% bonds when the market is giving them 8%? So I'm looking at Jay now, and he says, no, he's not interested in my bonds anymore. So guys, how do I get him buy my bonds? I can't rub off the 7% and write 8%. I can't do that. I've already printed these bonds. But what I can do is, I can offer him a discount. So let us say, I would tell him, instead of giving me $100,000 now, give me only $96,000. But when you come back after 5 years, you're going to collect all your $100,000. So that's a discount that I'm offering because my stated rate, my coupon is less than the market. So let's put it here. So this was a case of par value, where the market rate was equal to the coupon rate. So same rates. So we issued it at $100,000, and when we repaid these bonds, we repaid $100,000. Now we are issuing bonds at a discount, and the reason for that is the market rate is 8%, whereas our stated rate is only 7%. We've already gotten it printed at 7%. So when we issue these bonds, we are not getting all the $100,000. We are having to give a discount so that investors, they buy our bonds. So let's say we issue these bonds at a cash of $96,000 and a $4,000 discount. So let me use a blue pen for the numbers. So cash 96, but the bonds payable, that's still 100. Guys, think about it. Our promise is still $100,000, though we're just taking in 96 now. So that's the discount plug of $4,000. Now, every year when we pay out interest, we're going to be paying out interest at the stated rate, 7%. So we're going to be paying out interest $7,000 each year. So if you're looking at the interest, so even here we paid out cash 7,000, right? So we're paying the same amount of cash because the bond remains the same. We've given an initial discount. Now, so when we're paying in the next 5 years, so interest, we're having an interest expense to cash. Cash going out each year, $7,000. Now guys, think about it. We got this discount account, right? Discount on issuance of bonds. Let's do it on a balance sheet. So on a balance sheet, we're going to be having a bonds payable of $100,000, and we've given a discount. So we're going to have the discount along with the bonds payable. So the bonds payable, that's at $100,000. Why? Because the face value of the bond is $100,000. But have we borrowed $100,000? No, we just got $96,000 because our stated rate was less than market. So then we gave a discount of $4,000. The carrying value of the bond, that was 96. Now guys, after 5 years, nobody cares about this discount, right? The investors, they're going to forget that they got a discount. They're going to come back and collect the entire $100,000. So we have to amortize this discount on bonds over the life of the bond. So for now, let's assume we are amortizing it on a straight line method. Now the straight line method is not allowed. We'll talk about the effective interest rate method in a moment. But let's now, for a conceptual understanding, use straight line. So $4,000, this needs to go off in 5 years. So that would be approximately $800 each year. Now guys, the discount on bond issuance, this was a debit or a credit account? This was a debit account. That's why it's a contra liability, right? The liability is a credit number. Bonds payable, that's a credit number. The discount on bonds, that's a debit number. So to amortize it, we will have to credit it. So let's go look at what we're doing. So we have interest expense to cash. Now we also have to amortize the discount. So let's say we're doing it on straight line method. So that makes it $800 each year for the next 5 years. So the interest expense, though we've paid out cash $7,000, it's actually $7,800 because of the amortization of discount. So guys, let's do it there. So the interest expense instead of 7,000 is now 7,800, and $800 we've amortized the discount. So how much is discount now? It's 3,200. So this one becomes 96,200. Now think about it. Next year again we're going to be paying out cash $7,000, and let's say amortize this by another $800. So next year on the income statement we're going to have an interest expense of 7,800, and this discount number is going to be amortized, reduced. So this would now become $2,400. So the number here would be 97,600. So this would have been 96,800. Yeah. So this would be 97,600. Now at the end of the third year, so first year reduced, second year, at the end of third year, this number, discount number, would become 1,600. At the end of fourth year, the discount number would become 800. At the end of fifth year, when the discount is fully amortized, this discount number would become 0. So guys, we are amortizing discount over 5 years. So first year, second year, third year, fourth year, fifth year. After 5 years, discount is 0. We have a bonds payable of $100,000. Then the investor is going to come back to us with this piece of paper where we've promised to pay $100,000 and we will honor that commitment. We're going to pay him $100,000. So let's pay him back. So guys, when we issued the bond, we created a discount because our rate was less than market. Nobody was ready to buy it. So we gave a discount. We amortized the discount over the life of the bond. So guys, this is over 5 years. Interest expense, this was over 5 years. This one is over 5 years. So every year we're paying out cash and we are amortizing some part of the discount. After 5 years, when the investor comes back to us, we're going to repay him off and we give him cash of the entire $100,000. So bonds payable to cash, $100,000. So guys, you're understanding the reason why we kept bonds payable at the face value $100,000, because our commitment is to pay back $100,000. The discount that we've given, we create another account for that so that we can amortize the discount. Now, this was bad news. When market rate went up, our stated rate was less, we had to give a discount. How about some good news now? How about after we issue the bonds, the market rate drops. The market rate for these bonds, such type of bonds, bonds with such credit ratings, becomes 6%. Now, we've already printed 7%. The market rate is 6%. Now, all the investors, they come to us. Everybody wants our bond. No, we can't rub it and make it 6% on this, can we? No, we've already printed it. So what we would do is we would charge a premium because everybody wants this. We're going to charge a premium for these bonds. So guys, now let's look at accounting for premium on these bonds. So this was a discount when nobody wanted to buy it because the market was offering more. Now we are offering more than the market. So let's do it on the other side of the board. So this was discount. Now we're doing premium. Now in this case, the market rate is less than stated rate. Market rate is 6%. The coupon, the stated rate on our bond is 7%. So let us say when we issue the bonds, instead of taking on $100,000 from the investors, we tell them, if you want our bond, better pay us $104,000. So though we'll pay you back only $100,000 after 5 years, now you pay us a premium, $4,000 extra, $104,000. So we're going to get in cash of $104,000. But guys, what's the face value of the bond? What's a liability after 5 years? That's only $100,000. So the bonds payable is $100,000. So what's the premium? 4,000. Now every year, how much interest are we going to pay out? We're going to pay out 7% of the face value, $100,000, $7,000 interest every year. So the interest amount that we have every year, cash goes out $7,000. Now guys, think of it. In this case, we had the discount which was amortized. So discount was a debit account. We had to credit it to amortize it. So we had a debit of 4,000. We credited 800, 800, 800 over 5 years. 4,000 went off, washed off, zero. We want the same thing with the premium, right? So let's get on the dashboard and look at what we're trying to do here. So on the dashboard, we have a balance sheet. So we have the bonds payable of $100,000. Now we are issuing these bonds at a premium. So that would be bonds payable at premium. Guys, premium is a credit account. So it's going to increase this liability. So add premium, $4,000. Now our liability is not $104,000. It's only $100,000. So after 5 years, we are only committed to pay $100,000 because that's what we signed out for. So that's why we're going to be amortizing this premium. So let's say we are again using straight line method. As I told you, we'll learn about effective interest rate method in the next section. But now let's get the concepts right with the straight line method. So let's say if I do straight line, $4,000 amortization over 5 years, $800 each year. So after the end of first year, this 4,000 should become 3,200. So this becomes 103,200. Second year, this should become 2,400. So this becomes 102,400. Third year, this becomes 1,800, 101, 800. So this becomes 1,800 and 101, 800. Fourth year, this becomes 1,200 and this becomes 101, 200. So this is first year, second year, third year, fourth year. And 800, 800 gone. Guys, I'm got so bad at calculations. So used to using calculators, you see, 2,400 becomes 1,600, 101, 600. Then it becomes 800. That becomes 100,000 and 800. On the fifth year, when this bond actually matures, then this premium amount becomes zero. So guys, if this premium amount goes off, how much is the bonds payable that's remaining? $100,000. That's amazing. So let's do that on our board there. So the cash that we're paying out is $7,000. We need to amortize the premium. This credit number of $4,000. Let's say we're doing straight line, 800 each year. So the premium gets amortized. So to amortize the premium, you got to debit it. If you're doing it by, let's say, 800 each period, what's our interest expense? So guys, though we paid out $7,000, our interest expense is only $6,200 here. So this is going to be over 5 years. So 5 years, we're going to amortize the premium. We're going to be paying out cash each period and then interest expense on our income statement. After 5 years, when the investor, he comes back to us with a bond, we're going to give him back $100,000. Guys, he paid us 104 when he took the bonds because everybody wanted our bonds. Now when he's coming back with the bonds, we'll return him back only $100,000 because that's what we have signed on the bond. So guys, if the market rate was equal to your stated rate, simple, easy. You issue it out for $100,000. When you repay $100,000. So in this case, market rate is equal to stated rate. Spelling mistake. Stated rate is equal to 7%. Now here, market was offering more than our bond, so we had to give a discount. We amortized the discount. The discount amortization led to an increase in our interest expense over the next 5 years. Now here, when the market was offering less than what a bond was offering, we got a premium for a bond. And that premium amortization actually reduced our interest expense over the next 5 years. After 5 years, we give back the face value on the bond. So let's quickly do this on the dashboard and then we're going to get back to the book. So if I'm looking at the interest expense number here, so in case our bond was issued at par, the interest expense would have been $7,000. If it was issued at a discount, that would have increased, the discount amortization would have increased our interest expense, would have been 7,800. But if we issued at a premium, this would have been reduced, it would have become 6,200. So this was when there was a premium, this was discount, this was par. So guys, we're working on the interest expense number on our income statement. On the balance sheet, we are looking at the bonds payable number, which stands at the face value. To this, we less any discount that we offered, the unamortized discount, the discount which is not yet amortized, and we add any unamortized premium. So bonds payable, less discount, add any premium. So you'll not have both discount and premium. For each type of bonds, generally you'll have either discount or premium. So guys, that's the bond that we've issued out. We're going to look at it on the book. On page 8, let's look at interest rates in accounting for bonds. Highlight stated or contract or face or coupon or nominal rate. So this is the rate of interest printed on the bond and represents the interest payable by the borrower, right? Versus, and we're going to compare this rate with highlight market or effective or yield to maturity or the real rate. This is the prevailing market rate of interest for the bond. So we're going to compare the stated rate versus market rate. Highlight, if stated rate equals market rate, the bonds will sell at, highlight, face value. Highlight, if stated rate is less than market rate, highlight, discount. If the bond is paying less than the market, the bonds will sell at a discount in the market. Highlight, stated rate greater than market rate. Now in that case, the bond will sell at, highlight, premium. Now, whenever we are issuing out bonds at a discount or at a premium, there are a few considerations that we have. The first consideration is that what is the correct discount amount? We've used an approximate number, $4,000 here, but now we'll look at how to calculate this discount amount. What we're going to do is we're going to look at the cash flows over the life of the bond, and we're going to discount it to present date, to present value using the market rate. Not the stated rate, the market rate. So though we'll be paying out interest at the stated rate, we're going to discount it using the market rate. So we'll look at that in a moment. So that's our first considerations. Present value, the cash flows over the life of the bond to calculate the correct discount number. This number isn't correct. We need to calculate the right number. Next consideration is to find out the amount of interest expense each period. So that would depend on the cash amount, that remains fixed. But what would vary is this amortization of discount. Now I've used straight line method here, and I've told you straight line method is not allowed. We'll be using the effective interest rate method. So that's going to be the second thing for which we're going to be building up an amortization schedule. So present values here, amortization schedules here. So two things that you need to remember, and you'll rock whenever you get questions related to effective interest rate method, bond discount amortization or premium amortization. So let me rub this third journal entry so that we have a little more space to show what I want to show you here. Let's look at an example that we have on the book to get into details. So we have the example on bonds amortization of discounts. It says James Bond Company. So that's my CPA reviewer, just the same. Issues bonds of face value $100,000. Fair enough, same number. Semi-annual interest at 7% contract rate. Okay, the interest rate is still 7%. But what they're doing is, instead of paying out interest once in a year, they're paying out interest twice in a year. So instead of paying out 7%, $7,000 at year end, they pay $3,500 mid-year, $3,500 at year end. So this becomes semi-annual. And then you have maturing in 5 years. So the term still remains 5 years. Market rate of 8%. So stated is 7%. Market is 8%. Now guys, with a semi-annual interest rate, what you need to understand is the interest rate reduces to half. So instead of paying out 7%, they're paying out 3.5% each period. Instead of a term of 5 years, it's now 10 periods. So guys, you're getting it. We are dividing this by half. Instead of 7%, we'll call it 3.5% now. Instead of 5 years, we're going to call it 10 periods. So if we look at the cash flows from this bond, and if you look at the years now, let's say you have years 1, 2, 3, 4, 5, years 5, and but 10 periods, 6, 7, 8, 9, 10. So 1 and 2 period, that's year 1. 3 and 4 period, that's year 2. This is year 3. 7 and 8, that's year 4. 9 and 10, that's year 5. Now, each period, they'll be paying out interest at 3.5%. Stated as 7, so they're going to be paying out 3.5 each every 6 months, semi-annually. So $3,500 of cash flows across this period, across 10 periods over 5 years. At the end of 5 years, or at the end of these 10 periods, we're going to be giving out the face value of the bond, $100,000. Remember the repayment, $100,000 happens after So guys, now to calculate the present value of this bond, we have to use the present value factor for this annuity. So this is an annuity of 3,500. So it's 3,500 at the end of period 1, 3,500 period 2, 3,500 period 2. So 3. So it's 3,500 each period over 10 periods. And the discount rate that we're going to use is this market rate of 8%. So 8%, again we're going to divide it by 2. 4% is going to be our discount rate. So guys, how did we calculate this number 3,500? We took the stated rate 7% divided by 2 because it's semi-annual, we said 3.5%. So 3,500. So to calculate this number, how much interest you're paying? Guys, simple logic. How much interest are we going to pay on this bond? That is going to be based on the stated rate, what we have printed, what we have signed up on. So that is going to be our calculation for the cash flows. But for the discounting, we're going to use market rate. So you're going to use stated rate, coupon rate to calculate your cash flows. You're going to use market rate to discount those cash flows to present date. So now let's look at the present value factors that they've given us. So it says number 1, calculate the bond premium or discount. Number 2, show the journal entries. Number 3, show the bond amortization table. So a lot of work for you here. It says, note that we always use the market interest, so that's 8% in this case, to calculate the premium or discount. Since interest is semi-annual, to calculate present value, interest rate will be 8% by 2. Even the cash flows is 7% by 2, right? So instead of 5 years, we're talking about 10 periods now. And N would be 5 into 2, 10. Now, it says the present value of the principal, that's present value of $1 at 4% and N is equal to 10. So present value of $1 for 10 periods at 4% interest is 0.67556. So what we're going to do is we're going to present value this to current date. So for present valuing this, we're going to multiply this by 0.67556. So $100,000 after 10 periods at 4% interest rate. So guys, you're getting my logic. 10 periods at 4% interest rate, that's 8% by 2. So 4% each period. So the present value of $100,000 which is coming in after 10 periods at 4% interest rate is $100,000 into 0.67556, which gives us 67,556. So we've calculated the present value of this cash flow. How about the present value of this annuity? Now we're going to be discounting that, calculating the present value of that. It says present value of the annuity of semi-annual interest payments of 3.5% of 100,000. So that's 3,500 each period. So present value says of annuity at 4% interest and N is equal to 10 is 8.111. So we're going to multiply 3,500 into 8.111 and this calculates to 28,389. Guys, so understand this. Think about it. How much interest are we paying out on this bond? So let's say if we are issuing this bond, if Mild CPA Review is issuing this bond, semi-annual interest, how much interest are we paying out? We're paying out 3,500 over 10 periods. So that calculates to $35,000. So though we are paying out $35,000, that is happening in future periods. The present value of that annuity of a total of $35,000 is only $28,389. So though this calculates to 35,000, 10 periods, 3,500. The present value is 3,500 into 8.111, not 3,500 into 10, because we are reducing it. Think about it, right? I gave you the concept of time value of money. Money grows with time. So this becomes 28,389. Now, if you sum up these two, so this is the present value for the interest payments. This is the present value of the principal repayment when the bond matures. So the sum of this gives us 95,945. So guys, that is the present value of this bond at the market rate, at the effective interest rate. That's why this is called the effective interest rate method. This market rate, that is your effective rate. So now the discount number, so these were all dummy numbers that are given. Let's get to the actual numbers now. So the discount number that you'll have here, So the cash received would be 95,945. Bonds payable, that's $100,000 face value. The discount number is 4,055. Now this $4,000, so we've done our step one. We've successfully calculated this present value. So let me do a little bit more spacing here. Okay, I think that's good. We'll manage with this, yeah. Now for step two, I told you we'll be building up an amortization schedule to amortize this discount that we've calculated to be $4,055. So we're going to be building up a schedule where we'll have period, we'll have effective interest. So guys, what is the effective interest rate here? It's 4%. Because it's semi-annual, 8% by 2, 4%. What's the interest paid? That's being paid at the stated rate. What's printed on the bond? 3.5% each half year. This helps us calculate the plug for discount amortization. And after the discount amortization, the bond's carrying value would naturally change. So guys, looking at this, the bonds payable on a balance sheet is going to be at $100,000. What's the carrying value of the bond? It's going to be $100,000 less discount on bonds 4,055. The carrying value is going to be 95,945. Now what we're going to do is in period 1, we're going to calculate 4% of this. What's your effective interest rate? 4%. So calculate 4% of this. 4% of this calculates to be 3838. But how much have we paid? We've paid only 3,500. So guys, the effective interest rate is 3838. We've paid 3,500. What's your plug for discount amortization? You guys are getting what I'm trying to do here. So what we are saying is the effective interest rate, our interest expense is 3838. But we've paid out only 3,500. What's your plug for discount amortization? The plug for discount amortization is going to be $338. And now your discount number on the balance sheet would reduce. So your discount number on the balance sheet was 4,055. So let's do it on the balance sheet now. Let's get there. So when we started on with this, drop this off, clear this, less discount, yeah. So we said $100,000 less discount of 4,055 gives you 95,945. Now at the end of period 1, that's the first 6 months, we have amortized the discount by $338. So the 4,055 of discount that we had is now reduced by $338. That gives us 3717. So guys, what is the new carrying value of the bond? That's 100,000 minus 3717. This gives us 96,283 or 282. So guys, you're getting this logic, right? When you're amortizing your discount, the carrying value is increasing because this number, the reduction number, the less number is getting reduced. So let's get back there. So when we had effective interest 4%, so we used carrying value into 4% to calculate the interest expense. But we paid out cash 3.5, so the plug for discount amortization was 338. The bond's carrying value is now 95,945 plus 338. That gives us 96,282. Now the way you do it is, you could say 3838 minus 3,500 is equal to 338. 945 plus 338 gives you 96,282. So this minus this is a positive number. Now next period, at period 2, that's 7th month to 12th month, we're going to calculate the effective interest rate on the new carrying value, not on the old carrying value, on the new carrying value. New carrying value is 26,282. So take 4% of this. So 4% of the new carrying value would give you 3,851. So guys, what I'm trying to say is, though you might have paid 3,500 only, because the stated rate is 7%, paying half of that, 3.5, 3,500. Your interest expense for your income statement should be 3,851. So this number here, which is 3,838 for second period, I need a little more space here. So let me rub this, try to do it, redo it again. Okay, this was 28,389. This was 67,556. Total was 95,945. Now, when I'm looking at the interest expense for the second period, how much is that? 3,851. So let me also create here. 3,851. How much is paid out in cash? 3,500. What's the discount amortization? The difference, 3,851 minus 3,500 would give you a positive number of 351. So now you're going to add this positive number to 26,282 and you would get 96,634. Am I right? Yes, I am. Now, third period, again, you're going to calculate the effective interest rate 4% on this number. So 4% of 96,634 would give you 3,865. So your interest expense for third period would be 3,865. But how much have you paid? You've paid only 3,500. So what's the plug for discount amortization? That would be 3,865 minus 3,500. That gives you 365. Yes. Simple words, 3,865 minus 3,500 would give you a positive number of 365. You're going to add this to 96,634 and you're going to get 96,999. So guys, as you understand, the carrying value is growing. Why is the carrying value growing? Because at the end of 10 periods, 5 years, we have a liability to pay of $100,000. So the bond carrying value at the end of 5 years or at the end of 10 periods should be $100,000. So though we've issued the bond at a discount, 95,945, in 10 periods or in 5 years, we're going to grow this number. At the end of 10th period, this number would be $100,000 because that's the liability, that's the bonds payable. Basically, all the discount that you have is going to be amortized over these 10 periods. So you're going to have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. After 10 periods, the discount number is going to be 0. And you're just going to have this bonds payable on your balance sheet and you're going to be paying this out by cash. So bonds payable debit, cash, credit, cash goes out at the end of 10 periods, $100,000. So guys, what you need to take away from this is 2 steps that I've given you. Simple, easy. Step number 1, calculate the present value of the cash flows. So that would be the value at which you're going to issue out the bonds. So that's the cash you're going to collect. The remaining is going to be a discount. Or if the market rate is lesser, it's going to be a premium. So you're going to calculate first the present value. So you're going to look at 2 present values. Present value, the first present value is the interest cash flows. That's going to be an annuity. Next present value, you're going to look at the present value of the principal. That's present value of $1 at the end of the term. So you're going to discount that. What is the discount rate that you're going to use? So you have calculated, guys, think of it simply. You got to use each number once. So you've already used the stated rate when you were calculating the cash flows, right? You've used the stated rate of 7% by 2, that's 3.5% to calculate $3,500 each period. So to discount, you got to use the other number, that's the effective interest rate. That's why it's called the effective interest rate method. So you use 8% by 2, 4% to discount it all to present date. Once you have discounted it, created the discount account, remember you got to amortize it. How do you amortize it? By creating an amortization schedule, step 2. So you have the bond carrying value. Carrying value is basically what, guys? How do you get this carrying value of 95,945? This is 100,000 of the bonds minus 4055. That gives you 95,945. How do you calculate 96,282? So this bond discount would get amortized. So the bond discount is getting reduced. So let me look at the number that I calculated there. It's going to be 3717. So it's going to be $100,000 minus 3717 becomes 96,282 or 283. That's a rounding off error. So guys, this is the carrying value. Bonds payable is always $100,000. We are amortizing the discount. Every period the discount is getting reduced. So the unamortized portion of the discount at the end of the first period is 3717. So that keeps on getting reduced such that after 10 periods is 0. Now one thing I want you to observe here, the effective interest rate number is increasing every year. The interest paid number, this is constant every year. The discount amortization is also increasing every year. So first year we amortize $338, next year 351, then first period 338, second period 351, third period 365. So in a straight line method, the amortization was straight line. Now the amortization is increasing. So let's get to the book, look at this example, and we'll again do this for premium and premium amortization. On page 10, we're looking at an example on bonds where we amortize bond discount. So circle discount. It says James Bond Company issues bonds of face value $100,000, semi-annual interest at 7% contract rate, maturing in 5 years, and market rate 8%. So right, stated rate is less than market rate, which means discount. Now looking at the first part of the solution, we calculate the present value of the principal and the present value of the annuity of the semi-annual interest payments. So put a box around 67,556 and write present value of principal. Put a box around 28,389 and write present value of interest payments. And 67,556 plus 28,389, that gives us, put a box around 95,945. That's the amount of cash coming in for the bond. The face value of the bond, that's $100,000. This means highlight bond discount 4,055. Now this discount needs to be capitalized over the life of the bond. So we're going to have a discount amortization where the debit is going to be interest expense and the credit would be highlight bond discount. Looking at the amortization schedule on the bottom of this page, the first column there, you got effective interest at 4% of carrying value. So highlight effective interest and right there at market rate, because 4% that's semi-annual interest rate at 8% market rate. Next column, highlight interest paid, that's the rate of interest printed on the bond. So write at stated rate. And this helps us calculate, highlight discount amortization. The last column, that's bond carrying value. Highlight 95,945 and right there, cash received on issuance. So we're going to increase the bond carrying value every period such that it gets to $100,000 at maturity. The gap, that's 4,055 of bond discount, which is going to be amortized. So another column for discount amortization For all the 10 periods, put a bracket and write total equals 4055. And the bottom right number on this amortization schedule, basically the last number, the bond's carrying value, highlight $100,000 and write face value to be paid on maturity. So if we look at the column for effective interest, we see that the effective interest increases every year. So right, increases every year. Even the discount amortization, right, increases every year. So guys, I'm sure by now you remember my two-step technique for you to calculate the discount amount and amortize the discount. So first step was present value using market rate, and then build up this amortization schedule, amortize the discount. Same steps when it's a premium. So again, when you're looking at calculating this premium amount, I've given you approximate numbers. So let's rub that all here. So your first step is to calculate the amount of premium. Bonds payable, that'll be at 100,000 only. Second step is whatever premium you calculate here, you got to amortize it over the life of the bond. At the end of the life, repay off $100,000. I'm rubbing it because I need a lot of space here. So now, quickly looking into the problem for amortization of premium. So it says James Bond Company issues bonds of face value $100,000. Again, semi-annual interest at 7% contract rate. Guys, semi-annual means it simply doubles your periods. So instead of 5 years, we're looking at 10 periods. So here what we did was, stated it was 7%, we divided by 2 and we took 3.5% for each period. Market rate was 8, we divided by 2 and we took 4% to discount it. And we took 4% as our effective interest here. Same thing we'll do here. 6% we'll divide by 2. We'll take 3% to discount and for the effective interest, and stated rate would be 3.5%. So we'll take 3.5% to calculate the cash flows. So guys, you remember that? Use stated rate, the coupon rate, what you've printed. You can't change that. Use that to calculate the cash flows. Use the market rate or the effective rate to discount it to present date. So now, if you're looking at this again, so again you have 10 periods, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 5 years, year 1, year 2, year 3, year 4 and year 5. The cash flows each period from this bond would remain the same. So it says James Bond Company issues bonds of face value 100,000, semi-annual interest 7%, maturing 5 years, market rate 6%. So calculate bond premium, bond discount, journal entries and the amortization schedule. So guys, if you're looking at the cash flow, it's 3,500 each period over 10 periods, and at the end of 10 periods you get the face value of the bond back. So you give it back $100,000 gone out after 10 periods, 5 years. Now we're calculating two discounts. Remember, we did it twice. So once we are looking at for the principal, so present value of $1 after 10 periods. What's your discount rate? 3%, the market rate. So if you use this to discount it, the present value factor is 0.7441. That gives you 74,410. Now if you discount this annuity of 3,500 over 10 periods at a discount rate of 3%, the number is 8.530. So 3,500 into 8.530 is 29,855. The total year is 104,265. So guys, looking at this discounting of annuity, what's the total amount of interest payments that you're making over the next 10 years? The undiscounted amount, that's 3,500 into 10 periods, $35,000. But when you discount that annuity to present date using 3% interest rate, the number is 29,855. So you're discounting 35,000 annuity 3,500 over 10 periods to present date using the market rate. Guys, remember, you've used stated rate to calculate 3,500. Now you're using market rate to discount it. So the premium is 4265, and because our bonds are offering more interest than the market, we collect 104,265 on bonds with face value of $100,000. So guys, we're getting more, we're taking a premium. Why? Because we're giving you more. We're giving you more interest than what the market is giving you. That's why we're charging you more. Now, so that's the calculation of the premium amount. Step number 2, amortize this. Guys, even though we've charged you a premium now, we've charged you 104,265 at the end, at the maturity of the bond, we're going to repay only $100,000, the face value of the bond. So this premium of 4265 needs to be amortized over the period of the bond, of the term of the bond. So the term of the bond is 5 years or 10 periods. So let's build up a similar amortization schedule. So guys, you need to remember this. First, we are looking at the period. So period would be 0, 1, 2, 3, go on till 10 periods. Then we are looking at the effective interest. That's the reason we call it the effective interest method. So the effective interest here was 4% because the market rate was 8 by 2, 4. Here the effective interest is 6 by 2, 3%. Now, then we're looking at the actual interest that we've paid out, the cash that we've paid out. That is at stated rate, 7% by 2, 3.5. So interest paid at 3.5%. Now, this would help us calculate the plug for premium amortization. We're going to amortize the premium here. Because here you amortize the discount. Now you're looking at premium amortization. This would get you the bond carrying value. So now, what's the bond carrying value when you issued the bonds? 100,000 for the bonds payable plus premium 4265. Guys, here it was 100,000 minus discount, because bonds payable, that's a credit number, but discount was a debit number. So 100,000 minus 4055 give you 95,945. Here it's 100,000 plus 4265 because premium is a credit number. So this gives you 104,265. Now the effective interest on this at 3%, that calculates to 3,128. How much interest have you paid out? 3,500. So guys, I gave you this trick here. So you had this minus this is equal to plug. So 3,128 minus 3,500. That gives you a negative number. So the negative number 372. So that is your plug. So because this is negative, this is 104,265 minus 372, which gets you 103,893. Again, 103,893 into effective interest rate 3%, that gets you 3,117 minus 3,500, give you a negative number of 383. That's your premium amortization, and your carrying value after the amortization in the second period is 103,510. So guys, look at the journal entries here. What is the cash that has gone out each period? 3,500 as per the commitment, as per the stated rate, coupon rate. 3,500 is the cash that's gone out. But what is the interest expense? In period 1 it's 3,128, in period 2 it's 3,117. So guys, what's happening is the premium, the amortization of the premium is helping you reduce your interest expense. You're at a benefit, so now you're going to have lesser expense over the next 5 years, 10 periods. In this case, the discount, because you issued at a discount, the discount actually increased your interest expense. So it was 3,500 plus 338, give you 3,838. This plus this gave you 3,851. This plus this gave you 3,865. Now, because it's a premium, premium was a credit account, you're going to debit it. It's helping you reduce your interest. So this minus this, that's your plug. The plug is 372 and 383. So though you're paying out 3,500, the expense is only 3128 on your income statement. Though you're paying 3,500 in period 2, the expense on your income statement in period 2 is 3117. Now let's continue doing this amortization schedule. I know you're loving doing it. You want me to do it for all 10 periods, but I'll leave that to you. You have it on your book, look it up. So we're doing 1, 2, 3, and then we'll get to period 10 directly. So third period, we're doing 103,510 into 3%, that gives us 3105. So that's for the third period, minus 3,500. The plug for premium amortization is 395, and the bond carrying value is 103,115. So guys, bond carrying value. When the bond carrying value was 104,265 when we issued the bond, it was the bonds had a face value of $100,000 plus premium 4,265 give you 104,265. When it was 103,893, the face value was $100,000 plus premium of 3,893 gave you 103,893. When it was 103,510, 100,000 face value plus 3,510 give you 103,510. So guys, you're getting it right. The premium is reducing, it's getting amortized. The premium was 4,265, it got amortized, reduced 3,893, further amortized 3,510. At the end of 10 periods of 5 years, what's going to be a premium amount? 0, because over those 10 periods, you're going to amortize all this premium. This is going to go off in 10 periods. So after 10 periods, the premium amount is 0. What remains on your balance sheet is bonds payable $100,000. Then your investors come with a piece of paper, that bond, and you give them the $100,000, bonds payable debit, cash credit. So at the end of 10 periods, this number is $100,000, the bond carrying value, and then you pay it off, it's gone. So you issued the bond, collected cash from investors, you might have issued at a discount or at a premium, you could even do it at par. At the end of the term of the bond, the investor comes back with the bond, you repay him off what you're taking, you repay him off the face value of the bond. Now if you issue it at a discount, you collected 95,945, but at repayment, you give them back $100,000. So guys, this amortization table started at 95,945, the cash that you collected, ended at $100,000, the cash that you paid out. Here, it started at 104,265, the cash that you collected, ended at $100,000, the cash that you paid out. Very important for you to understand. So guys, quick takeaways: discount versus premium. Discount, your market rate is more than stated. Premium, your market rate is less than stated. So here you're offering more than market, here you're offering less than market. There, that's why you have to give a discount. Here you charge a premium for your bonds. Calculated the discount and premium using present value. For present value, always use market rate. So calculated the discount here, premium here. Amortize the discount here, amortize the premium here. So that was simple and easy, very important for you to understand. Quick look at the analysis that we're trying to do here. The effective interest is actually reducing every year. So even here, it was increasing every period because this carrying value was increasing. So effective interest was increasing. Here the carrying value is decreasing, so the effective interest is decreasing. Here you had the plug for a discount amortization that was increasing every year. Even in this case, the amortization, the absolute value of amortization 370 to 383 is increasing every year. So let's get to the book, look at this example once again, and then guys, we are good to go. We'll quickly come back, compare this with the straight line method. I'll draw a chart for you, and then you will be able to appreciate this effective interest rate method. Once again, effective interest means the market rate. So in case of a discount, this was 8% by 2, 4%. In case of a premium, this was 6% by 2, 3%. The example on page 11 is about amortization of premium. So circle premium. In this case, we see that the stated rate is 7% and the market rate is 6%. So right, stated rate greater than market rate results in premium. The first part of the solution, we calculate the present value of the principal and the present value of the annuity of semi-annual interest payments. Put a box around 74,410 and write present value of principal. Put a box for 29,855 and write present value of interest payments. Now 74,410 plus 29,855, that gives us, put a box for 104,265. That's the cash received on the issuance of this bond. Now this one is more than the amount printed on the bond, the face value of the bond of $100,000. That's called highlight bonds premium of 4,265. Now this premium would need to be amortized over the life of the bond. So we're going to amortize by debiting bond premium. So highlight bond premium debit, and the credit would be to interest expense. So the amortization of bond premium would help us reduce the interest expense over the life of the bond. Now let's look at the amortization schedule towards the bottom of this page. You got period, and then the first column, highlight effective interest and write at market rate. So market rate was 6%. Since it was semi-annual interest payments, we took in 3% here. Next column, highlight interest paid and write at stated rate, the rate printed on the bond. This helps us calculate, highlight premium amortization. The last column, we're looking at bonds carrying value, highlight 104,265 and write cash received on issuance. Now since we need to move from 104,265 to $100,000 by the time the bonds mature, we need to amortize the premium of 4,265 over the 10 periods across 5 years. So under the column for premium amortization, put a bracket for all the 10 periods and write total equals $4,265. And then highlight the bottom right number on this amortization schedule, the last carrying value number of $100,000, and write face value to be paid on maturity. Doing a little analysis here, if you're looking at the effective interest rate column, we see that the effective interest decreases every year. So right there, decreases every year. With the premium amortization column, we see that the premium increases every year. So right, increases every year. So the premium is amortized at an increasing rate. Now, we looked at amortization of bond discount and premium using the effective interest rate method. So that's when we used the market rate, the effective rate, to discount the cash flows that we were getting from the bond to present value, and then we build up the amortization schedule using the effective interest rate. So for the discount case, we assumed the market rate is at 8%, naturally higher than the stated rate. So 8% by 4%. Why? Because we were looking at semi-annual interest payments. So we had this effective interest rate amortization schedule. Now guys, if you look at it, what's happened here is the discount amortization is lower initially, but as we move on with periods, the amortization amount for the discount increases. So you could say this is like a real life race where you start running, but as you build momentum, you run faster. So we're moving from 95,945, the carrying value when we sold off the bonds, when we issued the bonds, to the time when the bonds mature. So we ran slowly initially because the amortization was a little lower, but as we moved on, we started running faster till we reached maturity, $100,000, 5 years, 10 periods. Now, when we look at the premium amortization, same rules. So, if you look at this, we issued the bonds at 104,265 and at maturity we needed to get to $100,000. Again, the premium got amortized using the effective interest rate method. The market interest rate, in this case, it was 6%, again by 3%. Why? Because it was semi-annual interest payments. Now, when we moved from 104,265 to $100,000, we started running. Initially, we ran a little slower. It was 372. Then, as we built momentum, the speed increased. So it was 383, 395, such that we reached $100,000 in 5 years or 10 periods. So guys, this was amortization using the effective interest rate method. When the amortization amounts is a little lower initially, as you go on, it increases. How about amortization using the straight line method? Now, in that case, you would have the same amount of amortization each period. Now, we've done a lot of effort learning about the effective interest rate method. This is because this method is a required method under GAAP. Now, straight line method, which is very easy, may be used in GAAP only when the interest amount that we have here, this interest amount, this is immaterial, very small. So in straight line method, what you do is, let's say we had this discount number of 4,055, which needed to be amortized over 10 periods. So we're going to divide 4,055 by 10. So let's say it'll be $405.50, or let's say $406. So we're going to have $406 each period for 10 periods. So this number, the discount amortization, is going to be $406 across periods. So in that case, it's not like you're running a race where you run slowly and faster. You run at the same pace. So at the same pace, you amortize the discount straight line method and you reach $100,000 again in 5 years or 10 periods. When you're looking at premium amortization, if this was straight line, the $4,265 of premium would have been amortized at a consistent pace through 10 periods. So that would have been, let's say, $426.50 or $427 each period. So this number, which we saw that under the effective interest rate method, it was increasing. Under the straight line method, it would have been consistent at $427 across periods. Now, as I told you, you got to use the effective interest rate method. Straight line method may be used under GAAP only when it's a very small interest amount. It doesn't matter, to the entity about the amortization of the discount and premium, small amounts. Now, the results that we just discussed, let's try to chart it out. So let's use this part of my board which looks empty. I mean, we can't leave anything blank here. So if we try to analyze, what we're doing here is, let's say this is year period 0 and this is year 5. Now, in case of discount, we are moving from 95,945. So this is at the point of issuance. So when we issued the bond, we collected cash of 95,945 in the case of discount. At maturity, we had to pay $100,000. So that was the face. So I could say this one is $100,000. So at maturity, we had to pay $100,000. Now, in case of a straight line method, what we did was we consistently moved from 95,945 to $100,000. In case of the effective interest rate method, what happened is initially we were a little slow. But as we went on, we gained momentum and we were faster, such that we reached $100,000 in 10 periods of 5 years. Same thing for premium amortization. So when it was the premium, the amount was 104,265. So this was the case of premium. This was the case of discount. So again, when we issued the bonds at a premium, in 10 periods of 5 years, we had to get from 104,265 of carrying value to $100,000 carrying value, because the bond, we had to repay $100,000 as per the face value of the bond. So in case of straight line method, we moved consistently at a consistent pace. So this was 4265 of premium. So we amortized it at $427 each period for 10 periods consistently. In case of the effective interest rate method, we ran slowly initially, but as we moved closer to maturity, our pace increased. We started running faster. We built momentum. So this was something like this. Initially, we went slowly. Later, we gathered momentum. So I've tried to chart out the results so that you can understand and appreciate the differences between the straight line method, which is not allowed, and the effective interest rate method, over which we spent hours learning. Come back to page 9 and highlight amortization of premium and discount. Highlight effective interest rate method. Right. Number 1, use stated rate to calculate interest payments. Number 2, use market rate to calculate present value and effective interest. So you got to be very comfortable with the use of stated rate and market rate. To calculate interest payments, naturally we got to use the interest rate printed on the bond, the stated rate. But to calculate the present value and effective interest, we're going to use the market rate, which is also called the effective interest rate. Then highlight straight line method, allowed only if interest is immaterial. Now jump on to page 12, where we look at the straight line method of amortizing bond premium or discount. So put a box around straight line method and write not allowed unless interest is immaterial. On the first part of the solution, we're looking at amortization of discount, circle discount. And on the amortization schedule, highlight discount amortization and write equal 4055 divided by 10. So it's a constant amount of $405.5 or $406 each period. So below that column, write constant. We can see that the bond carrying value moves up from $95,945 at issuance to $100,000 face value at maturity. The next part of the solution, straight line method at amortization of circle premium. On the amortization schedule there, highlight premium amortization and it equals 4265, that's 4,265 of premium divided by 10 periods. That gives us a constant amount of $426.5 each period or $427 each period. So below that column, write constant. And we can see that the bond carrying value decreases from $104,265 at issuance to face value of $100,000 at maturity, because the premium of $4,265 is amortized over the life of the bond, and in this case amortized on a straight line basis. Now remember, this method is very simple and hence not allowed unless the interest dollars is immaterial. On page 13, we're trying to compare the effective interest rate method with the straight line method. Let's first look at the effective interest rate method. Put a box around that. Now we look at amortization of discount, circle discount, as well as amortization of premium, circle premium. Now look at the second row, interest expense. Amortization of discount, highlight increases each period. Now interest expense in case of amortization of premium, highlight decreases each period. Now this is because the amount of amortization under amortization of discount, highlight increases each period, and the amount of amortization for amortization of premium, even that increases each period. Now when we're looking at the straight line method, put a box around straight line method. The interest expense, highlight constant each period. Amount of amortization, highlight constant each period or straight line. Now on the second half of this page, we got a lovely chart. Now understanding this chart, we know that when bonds are issued at a premium, that's more than face value. At a discount, less than face value. Now over the life of the bond, we're going to amortize the bond premium or the bond discount such that the bond reaches its face value, which is actually paid out by the borrower or the issuer at maturity. So when you have $100,000 on the right hand side, right, face value to be paid on maturity. Now, we have looked at journal entries for issuance of bonds. So when we issued bonds at par, when a market rate was the same as the stated rate, we had cash to bonds payable, simple and easy. Then when we issued bonds at a discount, when the market was giving more than what our bonds were giving, then we created a discount account. So it was cash debit, discount debit and bonds payable credit. This discount was amortized over the life of the bond. So discount was created as a debit account, but we had to credit it to amortize it over the life, and that increased our interest expense. So at issuance, discount was debit. Let's get to premium. So when we were offering more than the market, when the stated rate was more than the market, we got a premium for our bonds. So it was cash to bonds payable and the premium was a credit. It increased the amount of cash that came in. Naturally, this premium got amortized over the life of the bond. So to amortize the premium, which is a credit account, we had to debit it. And the premium helped us reduce interest expense over the life of the bond. So at issuance, discount on bond issuance was a debit account. The premium was a credit. Now let's get to the dashboard and try to create a journal entry, a master journal entry, which would cover all kinds of bond issuance, whether you're issuing it at par, at discount or premium. So guys, I'm trying to make life very easy for you. So let me do this journal entry on this side. I'm using the entire board. I can't leave this space empty, can I? So let's put it here. So issuance of bonds. So when you issue bonds, simple journal entry, you know, cash is coming in and there's a bonds payable for you. So cash is coming in and there is bonds payable for you. So this is when the issuance is at par. If the issuance is at a discount, you have a discount on bond issuance as a debit account here. If the issuance is at a premium, premium is a credit. Now naturally you can't have both a discount and a premium. You will either have a discount debit or a premium credit. Now apart from that, when you're issuing out bonds, you might have certain costs directly associated with the bond issuance. Let's say you're trying to print your bond. So the printing and engraving costs. You might have legal and accounting fees. Legal fees, what do you pay to your attorneys? Accounting fees to CPAs. You might have underwriter commissions, what do you pay to your investment bankers, promotion costs. So all these costs associated with bond issuance are capitalized as BIC or bond issue costs. Now think about it. Whenever you're issuing a bond and you have costs for bond issuance, that's going to reduce the amount of cash that's coming in. Basically, you're going to be collecting in cash from your investors and you'll use that cash to pay your attorneys, to your accountants, your underwriters. So that would reduce the cash. So if we try to put that in this journal entry, we might want to debit BIC, bond issue costs. Guys, once again, if you don't put BIC in here, you've collected in cash, you will have a second journal entry which would state BIC debit and cash credit. Right? So you've collected this cash from the investors, then you've paid to your accountants, your attorneys, your underwriters. Now, instead of having this as a separate journal entry, let's put it right there. So it's BIC debit here. To give you a simple example, let's say we issued bonds at par $100,000, the first example that we had. And we had bond issue cost of $1,000. So if I try to put it here, the bonds payable is $100,000. Now cash that I got from investors is $100,000. but I had to spend $1,000 for the bond issue cost. So I created this big account for $1,000 and cash was 99,000. So now you're getting what I'm trying to do here. I'm trying to create a master journal entry for all issuance of bonds. So that was bond issue cost. Now, there might also be times when you are issuing bonds between interest payment dates. Let us say we have a bond which is paying interest on 30th June and 31st December. Now, ideally, we should have issued the bonds on 1st January to the investors. But some of the bonds, what we did was we issued, let's say, on 28th February. So the bonds were supposed to be issued on 1st January. But some of the bonds, it got delayed. We're selling a lot of bonds. Some of the bonds got sold on 28th February. Now, when we reach the interest payment date, 30th of June, these investors should be getting interest only for 4 months, not 6 months, because they've held the bond only for 4 months. So what we do is, now that'll be very difficult, right? We'll have to pay some investors for 6 months, some investors for 4 months. So at this point, what we do is, to all our investors in bonds, we're going to be paying interest for 6 months only. Think about it. Though these investors have been holding bond only for 4 months, they would be getting interest for the entire 6 months. So what we do is, when we are selling bonds to investors in between interest rates, we're going to tell them, see, we're going to be paying you 6 months when you reach 30th of June. So now you pay us for 2 months, take 6 months later. How much they got? They got 4 months. Because when they're taking the bonds, they're giving us 2 months. At 30th of June, they're going to get 6 months. So what we'll do is, that would increase the cash. So let us say, let me remove the bond issue cost and just get this in. So $100,000. Let's say we are having bonds payable of $100,000. Let's assume no discount, no premium, no BIC. And we are issuing it to investors on 28th of Feb. So it's $3,500 interest for 6 months. For 2 months, it's going to be 1,167 divided by 3,500 for 6 months. So for these 2 months, something which the investor should not have gotten is $1,167. So what we'll tell them is, give us cash, show us the money, $1,167. So we would create an account called accrued interest account. And instead of charging them $100,000, though we are issuing the bonds at par value, we'll charge them $101,167. So cash coming in is $101,167. So guys, we are taking, when we are giving out the bonds, when we are issuing the bonds, we are taking in cash for this 2 months, because they haven't been holding the bonds for the initial 2 months. They started holding the bonds only from 28th of Feb. When we reach 30th of June, we're going to pay them for all the 6 months, though they've held it for only 4 months. That's the reason when we issue the bonds, we take 2 months. When we are giving after 6 months, we give all the 6 months. So that creates an accrued interest account. So because now we are the issuers of the bonds, this accrued interest is sort of a liability. We've got to give it back to them. So this is created as a liability on our balance sheet. So guys, let's get to the book. Look at this journal entry, the master journal entry that I've created here, and also look at bond issue costs and accrued interest. So this master journal entry, look at this. You have cash and bonds payable, you know that. You could either have a discount or a premium, not both. If you have some costs for bond issuance, that'll be bond issue cost, big. If you are issuing bonds in between interest payments rate, you're going to have accrued interest accounts. So I know everything is sinking it together now. You can relate this to all that we've learned, and I've given you more content.
Now I want you to flip back to page 8. Towards the bottom of this page, we're looking at a journal entry for bond issuances. This one is very important. Put a star there, because if you understand this journal entry, you can handle any sort of problem on bond issuance. Highlight cash, because that's what's coming in on issuance of bond. This bond issue cost, which might be applicable at the issuance of bonds. On the balance sheet, BIC or bond issue costs, they are reported as, right, contra liability to bonds payable. So BIC is treated similar to discounts on bond payable, and they're reported as an adjustment to the bond payable liability. Now BIC in short are deducted from the carrying value of bonds, and the rule is to amortize them using effective interest rate method. So the amortization of BIC is similar to how we amortize discount or even premium on bonds payable. The bond could be issued at a discount or at a premium. So between discount and premium, right, or for discount, right, contra liability to bonds payable, because it reduces the carrying value of bonds payable. For premium, right, adjunct liability to bonds payable, because premium on bond issuance increases the carrying value of the bond. Now we know that bond issue costs as well as the discount or premium, they are amortized over life of bond. So put a bracket and write amortized over life of bond. On the credit, highlight bonds payable. Naturally, that's a simple journal entry. Cash coming in, bonds payable, liability getting built up. And we also talked about accrued interest. For that, right, current liability. Now turn a few pages and get to page 14, where we are looking at highlight bond issue costs or BIC. Now, bond issue costs are costs which are directly associated with bond issuance, like underline printing and engraving costs, legal and accounting fees, underwriter commissions, or promotion costs. Now, for bond issue costs, as we've just seen, right, reporting is as contra liability to bonds payable. Now, for bond issue costs, right, accounting is via amortization at effective interest rate method. Now, put a bracket there. So both the reporting and the accounting for these bond issue costs, these are, right, similar to discount on bonds payable. So basically, BIC or bond issue costs, they are highlight deducted from carrying value of bonds, and as we've just seen, they are highlight amortized using effective interest rate method. Then moving down on this page, we got bonds issued between interest dates. Highlight if bonds purchased or sold between interest payment dates, there is an highlight accrued interest. So this accrued interest is both for the purchaser and the borrower. For the purchaser, it's a current asset, but we are looking at the borrower's perspective. So circle borrower and circle liability.
Now let's look at accounting for convertible bonds. So guys, if you're here with me, you remember we talked about convertible bonds when we looked at classifications of bonds towards the beginning of this chapter. So in convertible bonds, the bondholders, the investors in the bonds, they have an option. Guys, remember from derivatives, option means right but not obligation. So the bondholders now have an option to convert the bond that we've issued to them to common stock. So guys, they can come back to us with this bond and take away our equity. So guys, what's happening here? The bonds payable that we have on a balance sheet, that is going off our books because this bond, when they come back to us, it's no longer outstanding. But equity, that increases because we issue fresh equity to them in exchange for these bonds. So guys, let's do the journal entry for this. So if I'm looking at convertible bond, rather let me use a blue pen for this. So as you see, I've cleaned up this section of my board because I needed more board space. So convertible bonds, what's happening is the bond payable is no longer outstanding. So the bond payable, when we issued the bond, it was a credit because this one is a liability on our books. Now it is getting debited. Now generally when you're issuing convertible bonds, you would want to charge a premium to the bondholders because those guys, they have an extra option here. So generally for convertible bonds, you would have premium on issuance, and when the bonds actually get converted, you need to debit the premium. Guys, bonds payable was credit, now you need to debit it. Premium was credit, you need to get it off. So on your balance sheet, let's say you had bonds payable of $100,000 and the unamortized premium of $104,000. Now this is getting off your books, so you need to debit both of them. Debit bonds payable, debit the premium. Now if you have some big associated with this bonds, the bond issue costs, they were debited, they were there as other assets here. Now you need to get them off, so you need to credit them. What are you giving in exchange? We are giving them equity stock in exchange. We are giving them our equities. So we'll have common stock given out. So let us look at an example on the book and we'll put the numbers on board. It says conversion option is exercised by a bondholder having a bond with face value of $100,000. So this bondholder, he comes back to us. The unamortized premium on these bonds is $4,000. Now the bond is converted into 100 equity stock at $100 par and $1,200 market value. Past journal entries under the book value and the market value method. So guys, first let's look at the book value method. The book value, this is more commonly used. So when we're looking at the book value method, we are not concerned with the market value of the equity that the bondholder is walking out with. We are only looking at book values. So think about it. When this bondholder comes to us, we've got bonds payable on him, $100,000. Premium, unamortized premium on those bonds of $4,000. So that all needs to be debited. Now he walks away with 100 of our equities at $100 par. So 100 equity stock, so 100 stocks into $100 par. That means on all the 100 stocks that the bondholder is walking out with, $100 is printed on the equity stock, $100 par value. So what's common stock? That's $10,000. So common stock credit is $10,000. Your debit is 104. Your credit is only 10. Where does the remaining 94 of your credit go? That goes into APIC, the additional paid in capital. So under the book value method, your plug for this journal entry is APIC $94,000. So that's your plug. You put 94,000 on your balance sheet out here. Simple and easy. $104,000, this was taken off your balance sheet. This went off. Instead of that, you now have equity on your balance sheet, 10,000 and 94,000. Simple, easy book value method. Now, the second approach that we're looking at is the market value method. And as I told you, not very commonly used. Now, in this method, we are concerned about the market value of the equity stock that the bondholder is walking away with. So once again, when the same bondholder comes back and we use the market value method, we're going to debit bonds payable $100,000, premium $4,000. That's clear, right? Because we're taking the bonds payable off our books. Now, when we're giving them equity, we are looking at what's the market value of the equity that we're giving to them. And on this example, the market value of the equity stock is $1,200 each stock. The par value is only $100. Market value is $1,200. So if we had issued these equity stocks in the market, we would have gotten $1,200 per stock. So for 100 stock, we would have gotten $120,000. $10,000 would have gone into common stock, $110,000 would have gone into APIC. Once again, if we had issued these common stock, this 100 common stock in the market for cash, the equity investors would have given us $120,000, 100 stock into 1200 market value, of which $100, the par value, would have gone into the common stock account. The remaining, over and above that, the additional paid in capital would have gone into APIC, 110,000. So that's the number you put for common stock and APIC. Now wait a minute, the debit is 104, the credit, that's 120. Now we need to plug it, so we need a plug of 16,000 here, and that's our loss on this conversion. So guys, they came to us and they gave us bonds which were at $104,000 on our books, and they walked away with equities worth $120,000, the market value of those equities. We had a loss on this conversion of $16,000. That's the plug. Now you could also have a gain if they come up with bonds which have a higher book value, higher carrying value than the market value of the equities. So guys, in the market value method, you're looking at what's the market value of the equity that the bondholders are walking away with when they exercise their conversion options. In the book value method, we don't know, we don't care about the market value of equity. We're looking at convertible bonds on page 15. So we look at both the methods that we just talked about. First, the book value method. Put a box around that. On conversion of the bonds to common stock, the value is at book value of the bonds. So there is underlined no gain or loss, and the plug is to APIC. If you look at the journal entry for conversion, the debit is to bonds payable because they are no longer outstanding. Any premium is also written off. So box bonds payable and premium and write bond carrying value. For bond issue costs, let's say it's 0, so write say $0. We're issuing common stock, so put a box for common stock in APIC and draw an arrow from bond carrying value. So the bond carrying value equals common stock plus APIC. Now looking at the market value method, put a box around market value method. At conversion, the value is at market price of the stocks or bonds, whichever is more reliable. Underline, plug the gain or loss on redemption. So on the debit, we have bonds payable and premium. Box that and write bond carrying value. Now there could be a loss or a gain. If there's a loss, that's a debit. So highlight loss plug. On the credit, we'll get off any bond issue costs, and then common stock plus APIC. Put a box around that and write stock market value. And if there's a gain, that's going to be a credit plug. So highlight gain plug on the credit side. So there would be either a loss or a gain on conversion. Now we've looked at convertible bonds, where the bondholders can come back to us with the bond, walk away with our equity securities. They have that option. Now let's talk about bonds with detachable warrants. Now in this case, what we do is we issue detachable warrants along with the bonds. So basically we issue out two securities, the bonds and the warrants. So the bondholders at a later point, they can keep the bonds with them, detach the warrants, come back to us, take away equity stock. Now the warrants would have an exercise price on them, so the bondholders would also have to give us some cash along with the warrant to take away equity. So guys, this is two securities. This was one security. The bond got converted to equity. In this case, it's two securities. The bond is separate. There's a warrant which may get converted to equity. The bondholders have an option to come back with the warrant, take away equity stock at exercise price. So guys, as you can understand, we're going to account for it as if we have issued out two securities. So on issuance, we're going to be getting in cash, and we're going to say this cash is for the bonds and for the detachable warrants. Okay, this looks like the warrants are coming free with the bonds, right? Yeah. So cash to bonds payable to warrants. Now, because warrants are convertible to equity, we would put the warrants in APIC. So we would have an account called APIC warrants. Now, we'll talk about APIC in detail when we're looking at stockholders' equity later in the course. But for now, understand bonds is bonds payable, warrants would go into APIC. Now, let us look at an example in the book and put the numbers from there. It says W company issues $100,000 par value bonds with warrants at $110,000. So they've issued bonds plus warrants at $110,000. What's the cash that's coming? $110,000. Now it says immediately after the issuance, the fair value of the bonds without the warrants was $96,000 and fair value of the warrants was $24,000. So guys, what happened was the smart bondholders, the moment we issued out bonds with warrants, they detached the warrants. Bonds were trading separately in the market, warrants were trading separately in the market. And the bonds had a fair value of $96,000 and the warrants had a fair value of $24,000. So they bought it from us at $110,000. Immediately after we issued it, it was trading in the market for $120,000. Amazing, right? They made a good bargain on this. So now, if you're looking at the relative fair value, so now we got to allocate this 110,000 that we received between bonds and warrants. We could look at the relative fair value of this immediately after we issued them. So we could say 96,000 out of 120, that's 80%. 24 out of 120, that's 20%. So we could say the bonds are 80% of this, warrants are 20% of this. Simple and easy, right? We're issuing two securities. We need to allocate all the cash that we got between bonds payable and warrants. We don't care about the market value, right? That's for the bondholders. They're trading in the bond markets. What we care about is how do we allocate it on our books between this and this. So the 110,000 we received, we would say 80% of that is for the bonds. So 80% of 110 is for the bonds. That's around 88,000. And 20% of this is for APIC warrants, that's 22,000. Now, bonds are recorded at face value, so we're going to have bonds payable of $100,000, not 88, and we'll have a discount account for the 12,000. So 100 minus 12 gives you 88. So guys, you're getting this logic, right? We are issuing out two securities, bonds and warrants. We are allocating the price that we've received, the cash that we've received between the bonds and the warrants separately. We're splitting it up. Bonds would go in here. So we would have $100,000 of bonds payable less discount. $12,000 gives us $88,000. The remaining $22,000 that we have goes here in APIC warrants. Is when we issued these bonds and detachable warrants, it looked like we sold it off for a premium, right? We got $110,000 for bonds with $100,000 par. But guys, that premium was because we had given out warrants free with the bonds. If we had given only the bonds, maybe we would have had to give them out at a discount, because the relative fair value method, we've seen that the bonds payable is 88,100 minus 12. On page 16, we're looking at bonds with detachable purchase warrants, where two securities are being issued, bonds plus the purchase warrant. So looking at the example on this page, solution step 1, calculate, highlight relative fair market value. And step 2, allocate the proceeds between the bonds and the warrants based on the relative fair market value that we calculated in step 1. So if highlight proceeds were $110,000, Highlight bonds without warrants would be $110,000 into 80% as we calculated in step 1 gives us $88,000. Highlight warrants equals $110,000 into 20%, again 20% from step 1. This gives us $22,000. Now looking at the journal entry, cash is debit, so write received 110. Now the 110 of proceeds cash received would be allocated between bonds without the warrants and the detachable warrants. So bonds without the warrants, that was 88. So put a box around 12 and 100. 12 is the discount on bond issue, bonds payable face value 100, and write $88 for bonds. For warrants, which goes into APIC, write $22 for warrants. So out of $110,000 of proceeds received, we've allocated $88,000 for bonds and $22,000 for warrants. Now we've spent a last couple of fun and exciting hours learning all about accounting for bonds. Now before I move on further and wrap this up, let's do a quick recap to make sure we're on the same page with all that we have on my big board out here. So if you recall, in FAR 3, when we looked at investments, we looked at the investor's perspective. And that could be investment in equities or in debt securities. So investment in debt securities, that was investment in bonds. Now the investors, they could account for their investments in bonds as trading securities, as available for sale securities, even held to maturity securities. Now in FAR 4, we are looking at the issuer's perspective of the bonds. So now we are the issuers. It's a bonds payable on our balance sheet, a liability. So this was what a bond looked like. So you had a face value on the bond, so it was a promise to pay a certain sum of money after a certain period of time, the term of the bond. And during that period, interest would be payable at the stated rate or the coupon rate. We could have many various kinds of bonds, and because we're looking at the issuer's perspective, naturally a lot of our focus was on the issuance of bonds. Now we could be issuing the bonds at par, so now we're collecting in cash equal to the face value of the bond. But if our bonds were offering a lower rate than the market, that means the market was offering a better deal, then we would have to issue our bonds at a discount. But again, if our bonds are offering a better rate than the market, stated rate more than market, then we would naturally charge a premium for our bonds. So here we create a discount account. Here we have a premium, and then we amortize this discount or this premium over the life of the bond using the effective interest rate method. Effective interest rate, that's your market rate. So we use the effective interest rate to discount the cash flows to present value, both the cases. Then we built up an amortization schedule, amortizing using the effective interest rate method. Then I also compared the effective interest rate method with a straight line method. So let us say we issued our bonds at a discount at 95,945. Now at maturity, we have promised to pay $100,000. So we have to grow this carrying value of 95,945 to $100,000 in 5 years. We do that by amortizing the discount. On the straight line method, the amortization is same amount each period, a steady amortization. Under the effective interest rate method, what happens is initially the amortization is a little slower, and then we pick pace later so that we reach this $100,000 in 5 years. Same thing for premium. You might have issued your bonds at, let's say, 104,265. So 4265, that's the premium amount which needs to be amortized over the life of the bond. Straight line method, same amount each period. Effective interest rate method, little slower amortization initially, and later you pick pace so that you reach the $100,000, the face value of the bond when the bond matures in 5 years. So guys, what happens when the bond matures? then the investor comes back to us with this piece of paper and takes back his $100,000. So it's bonds payable to cash. So guys, we have a bonds payable on our books, and then when it matures, when the investor comes back to us, we give him back the $100,000, the face value of the bond, because that was our promise out here. So if I'm looking at maturity of the bonds, or let's say retirement of bonds, it's bonds payable debit. So guys, we created a liability here. Now we are repaying off that liability. Cash came in when we issued the bonds. When we are retiring it, when we are repaying them, cash is going out. So let us say we issued our bonds at a discount. So that was 95,945 the number there, and the discount amount was 4,055. We had bonds payable of $100,000. Now in 5 years, this bond is going to mature. The investor, though he purchased it from us at a discount, he's going to come back to us with this piece of paper, take back his $100,000, which is typed in there. So cash came in 95 when we issued the bonds. We paid out interest during the life of the bond, and when it matures, we are paying out cash at the face value, the entire $100,000. Now, we could also retire the bonds prior to maturity, right? Think about it. We could go out to the bonds market, buy back our bonds. Or if we have issued callable bonds, we can call back the bonds. So that would be an early extinguishment of debt. Now think about it. I told you we're going to amortize this discount, or even if you have a premium, over the life of the bond. So if we retire the bond prior to maturity, before it matures, there would be some unamortized discount or premium lying in here. So even that needs to be chopped off. So guys, if you're retiring it at maturity, naturally all the discount and premium have been amortized over the life. But if you're retiring prior to maturity, before the bond matures, then you would have an unamortized discount or an unamortized premium, which also needs to be written off now. So if you have an unamortized discount, discount is a debit number, you got to credit it. So unamortized portion. If you have an unamortized premium, which is a credit account, you need to debit it. So guys, I guess you're getting this. The retirement journal entry is simply a mirror image of what's happening at issuance. So if it's a debit here, it's going to be credit here. If it's credit here, it's going to be a debit here. Now, naturally, if you're retiring the bond prior to maturity, you may have some unamortized BIC, which again needs to be closed off. So debit would now need to be credited. Now let us say you are retiring the bonds prior to maturity in between interest payments rate. Now the investor, he would need the interest for that period that if you're retiring in between interest payment date, he would need interest for the period he's been holding the bonds. So naturally you'll have to give out a little more cash. So that would be your interest payable. So here you collected in extra cash from the investors. Now here you're paying them out the interest for the period they've held the bonds and they haven't yet received the interest for. So you have another journal entry which would be interest debit to interest payable, and here you're closing off interest payable by paying out excess cash. So guys, simply whatever is a debit at issuance is a credit at retirement. Whatever is a credit at issuance becomes a debit at retirement. Now, when you're retiring the bonds prior to maturity, you might even have a gain or loss on retirement. Let me build up an example for you. So let us say we have this bond which we issued at a discount. Let's say in course of 2.5 years or so, the unamortized discount was $2,000. So now when we are retiring the bond payable is $100,000. The unamortized discount is $2,000. So the bond carrying value here is 100 minus 2, $98,000. Now we go out to the market and we buy back these bonds at $97,000. So guys, it's on our books for 100 minus 2, 98. But due to changing interest rates in the market price of the bond may fluctuate, go up, go down. So we go out to the market and buy back our own bonds at 97. So how much cash did we pay? We paid 97,000. So guys, unamortized discount was 2,000. So 100 minus 2, carrying value of the bond 98. We bought back our liability of 98 at $97,000. So in this case, we have a gain of $1,000. How about this liability of 98? We had to go out in the market and purchase it for $98,500. So in that case, the cash that we would pay out would be $98,500. Now in that case, we have a loss of 500. So guys, what I'm trying to say is, if you're trying to retire your bonds prior to maturity, you might have a gain or a loss. That's your plug on this journal entry. Now this gain or loss on early retirement of bonds goes to your income statement. On page 17, let's look at bond retirement. Reviewing the journal entry here, highlight bonds payable debit because the bonds are now no longer outstanding. The credit is to cash because cash is going out. And there could be a plug to a loss or a gain. So circle loss, circle gain. On the last bullet on this page, highlight bond sinking fund may be set up for the retirement of bonds. So because all the liability for bond retirement comes out at maturity, companies may be setting up bond sinking funds where they start saving in money so that they have enough cash to pay off the bonds when the bonds mature. So start saving so that you have enough dollars to pay when your bonds mature. Now in the US, you have a very large bond market worth trillions of dollars. It's called the fixed income market. So naturally, as you can understand, these bonds, they have a fair market value. Now that's based on the interest rate that's typed in here. It also depends on the term of the bond, and very important, it depends on the credit rating of the issuer, which determines the credit risk of this bond. Now remember, in FAR 3, we looked at the fair value option for investments. That would also be investment in bonds. So we looked at trading securities. They were always at fair value. Available for sale securities. Now, though they were at fair value on the balance sheet, any gain or loss went into OCI and was accumulated OCI on your balance sheet. We could also account for investment in bonds as held to maturity. In that case, we don't even care about what's the fair value. We account for it at amortized cost. Now, then I told you, you have an option to elect fair value option for these investments. So instead of doing available for sale, you could do a fair value option for available for sale. Held to maturity, you could do a fair value option even there. Now similarly, you can elect the fair value option for bonds as a financial liability. Here they were financial assets because that was an investment, investor's perspective. Now it's a financial liability. So if you elect the fair value option for bonds as a financial liability, instead of holding the bond at amortized carrying value, they are reported at fair value on each balance sheet date. Now, in that case, there is no discount or premium reported, and any gain or loss goes into your income statement under income from continuing operations. Now, I'm sure you remember the fair value option, which is irrevocable once made. So you can choose to get in, but once you're in, you can't get out. So guys, as I told you, remember, it's like marriage. You have an option before you get in, but once you're in, you're committed for life. On page 18, let's look at the fair value option. highlight election of fair value option for bonds as financial liability. Right, check out fair value of bonds payable in the bond market every balance sheet date. And right there, bonds payable FAR 4, because the concept of bonds as a financial liability has been discussed right here in this section in FAR 4. And if you elect the fair value option for bonds payable, highlight no discount or premium is reported and any gain or loss is reported on the income statement in income from continuing operations. Now, bonds as a financial asset or investment in bonds, that was covered in FAR 3. So right there, investment in bonds, FAR 3. I'm sure you recollect all the concepts, all the content that we covered in FAR 3. But let's make a little quick fix note on the bottom of this page. Right, from FAR 3, investment in bonds may be, right, trading, that's always at fair value. AFS or fair value option, now available for sale securities, though they are at fair value on the balance sheet, the unrealized gains or losses accumulate on accumulated OCI in the balance sheet. If you elect the fair value option, these would then go to the income statement. And the third classification for bonds would be HTM or held to maturity or fair value option for HTM.